Welcome to this Federal Reserve special report on WSJ Video. I am Paul Vigna with Anastasia Amoroso, Executive Director and Global Market Strategist at JP Morgan Funds. So, Anastasia, this afternoon, the FOMC, the Fed's rate-setting committee, comes out with their statement of their July meeting. No change in policy, which we expected.
Right.
But the real question is, what does this statement and this meeting say about what is going to come in September and down the road? And more specifically, do you think that this statement gets us any closer to a rate hike in September or sometime in the fall?
I think it absolutely does. If I look at the statement, the most important information to me is contained in the first paragraph. If you looked at the first paragraph, it's the assessment of the U.S. economy. And guess what? That's exactly what the Fed is watching to get us closer to that rate hike. So if you look at their assessment of jobs, they are saying for the first time, actually, perhaps, that we're seeing solid jobs gains. That is key, right? That's what gets us to that full employment mandate. If you look at their assessment of things like retail sales, the household spending, for example, same story. They're willing to look through the soft patch that we've seen in June, and they're willing to say that we do have moderate consumer spending. They have marked up their expectations, or their assessment rather, of housing numbers. So I think on net, this is absolutely much firmer language on the economic front that does get us closer to September liftoff. What
do you think about inflation? I mean, inflation continues to be low. They acknowledge that it continues to be low. It's not hitting their 2% target. How do they raise rates if inflation is still low? I mean, does that become, is this a line in the sand, or is this really a mushy target that they're going to just kind of take it broadly speaking?
So I think we have to point to the language here in the statement that says reasonably confident that inflation picks up to 2%. They don't have to have the preponderance of evidence. They don't have to be overly confident that inflation picks up to 2%. Right. Reasonably confident is the word. So that to me means they do need to see stabilization in energy prices. And they are going to see that the closer we get to year end. And the reason for that is if you start comparing oil prices, even though they've pulled back some, but if you start to compare that against the year ago levels, they're actually going to be a favorable comparison there, because remember, oil prices started to fall last year. I think on top of that, the fact that you do have the economic data firming up in the United States, and you have employment cost index, which we get on Friday, that will likely show continued wage growth, I think that's what gives them this reasonably. Not overly, but reasonably.
Reasonably? Okay. Let's talk about the fact that there were no dissents in this meeting. A lot of times you'll get one or two dissents. They're almost token dissents, but they do send a signal about what the participants in this group are thinking. There were no dissents this time. Does that mean anything to you?
I think it struck that perfect middle ground. It satisfied the hawks, it satisfied the doves, because I think the debate that is likely going on in the committee right now is, do we pay attention to the strength of the U.S. economy, which they're now saying there's moderate and maybe solid strength in the U.S. economy, or do we pay attention to its momentum? And in other words, the rate of change in some of the economic variables, it's really not that great. So the doves would say, let's pay attention to the rate of change. The hawks would say it's the overall level of improvement. But because this statement is basically allowing for this, dual outcome, they could raise, they could not raise. They have the evidence. Will they act on it? We don't know. I think it satisfied both parties of the Fed.
How much attention do you think the Fed is paying to what's going on either side of the oceans that surround us? You look at Europe, you look at China, especially with the stock market crash and their economy slowing, everything happening in the emerging markets. How much attention do they have to pay to what's going on in terms of if and when they raise rates? What is that going to do to the economy overseas, and how is that going to feed back to us? How much weight are they putting on that?
I think they're definitely putting some weight into this, and there's two different areas. The first one, of course, is inflation. So stronger dollar means lower imports for us, good news for us, but it does mean lower consumer prices, lower inflation, further away from the target. So they have to consider that capacity utilization, for example, in Europe and China is not enough to drive up that goods inflation. So that's one of the constraining factors. The second one is, you mentioned the Chinese market malaise. So if they think that the Chinese market malaise is actually going to spread to a broader economic malaise, that's a big deal, right? Even though we're not an overly externally oriented economy, we're all still connected. So if China slows down materially, that will have an impact on the economy. But I think the fact that they have not stopped from inching up their characterization of the U.S. economy, that tells me they're not overly concerned about the international developments.
All right, so our bottom line is no change in July, but probably a couple steps closer to maybe September or sometime in the fall. All data dependent, right?
Definitely a few steps closer to September, and we'll see that reflected, I'm sure, in the market expectations as well.
All right, great, Anastasia. Thanks for coming in today. Really appreciate it.
Good to see you.
Thanks a lot.